Hi everyone, and thank you for tuning into my channel where I talk about stocks, the stock market, and investing. I post videos daily, so if this sounds like something you want to get more of, please subscribe down below. In today's video, I'm going to talk about Amazon stock and evaluate whether or not it's a buy. I'm going to use my 6-step framework for analysis, so let's get right into it. The first step in my framework is the customer value proposition. And for Amazon, it offers fast and free shipping on millions of items and a streaming service, Amazon Prime, and that costs customers roughly $10 per month. So, a pretty good deal for customers. The streaming service alone, comparably, you could argue that it's worth $10 per month because others are priced similarly. And so you're getting the fast and free shipping on top of that, and you're still paying just $10 per month. So relatively good value for customers. And we could see that with revenue. Amazon's revenue has exploded from 61 billion in 2012 to 470 billion in 2021. Revenue would not have exploded by this much if it was not offering customers a great value. Or I should rephrase that, if customers did not perceive that Amazon was offering them a great value. My next step in the framework is unit economics. And for Amazon, this is a bit tough because I mentioned earlier that it offers fast and free shipping, but it's expensive to offer fast and free shipping. You could imagine a customer that might, a Prime member orders some item that might cost $4, and it might cost more to ship that item than the total price of the item. So Amazon counts on, bundling orders and getting consumers to use their subscribe and save service so that they batch all of their orders into one and get one delivery out every month. And that way, Amazon only needs to make one delivery. But that's not how customer behavior has evolved. It's, you think of something that you need and you go on there and you order it and you buy things, especially if you're a Prime member, you buy things one or two at a time. So this has proven expensive for Amazon, and it's what led to relatively thin operating margins for the company. Between 2012 to 2021, its operating margin increased from 1.1% to 5.2%. So it's showing evidence of economies of scale, even though the overall operating profit margin of 5.2% is nothing to celebrate, but showing that it's increased the operating profit margin by nearly fivefold in the last 10 years is impressive to be sure. And in the longer term, it has potential to lower delivery expenses through the use of technology. One emerging technology that could lower expenses is driverless tech. Drivers are a major expense of deliveries. If Amazon can adapt driverless technology for its use and have that lower its expenses, that could prove a major cost savings. How much? It's uncertain at this point, but uh, it's something out there that it is working on, and that could prove a benefit to its unit economics longer term. Moving on to my next step in the framework, which is the total addressable market. And for me, the bigger the better. The bigger market that a company is addressing, the bigger the potential. That way, when you have a company that like Amazon that reaches 500 billion in revenue, it's still not hitting anywhere near its ceiling because its total addressable market is so large, right? So it can continue growing even beyond 500 billion because the market allows for it to. Okay, so for Amazon, it operates in several massive industries, including e-commerce, which is a multi-trillion-dollar industry, advertising, which is a $763 billion industry, and cloud computing, which is roughly a $500 billion industry, depending on which estimates you consider. So for Amazon, excellent total addressable market. The next step in my framework is competition, and what I like to see here from an investor's perspective is limited industry competitive pressure. I don't like to invest in industries that are fiercely competitive because when businesses compete with each other, they compete at the expense of their own margins, and decreasing margins is bad news for investors. For Amazon's case, the e commerce industry is growing more competitive, and where the competition is focused on is increasing services, right? So you're not seeing competition lowering prices because most businesses already offer free shipping, right? Almost anywhere you shop online nowadays will offer you free shipping. With, of course, one company might say you got to order a minimum of 15, another might say 25, another might say $50 in order to get that free shipping. But most companies will offer you free shipping nowadays. And so that's where the competition is heating up. Is businesses are saying, with us, you can get free shipping on only $25 of sales. And then another company might say, with us, there is no minimum. You can get free shipping on any amount of sales. And then they're saying, okay, with us, you can get free shipping guaranteed in 2 days. And another company might say, okay, with us, you might get free next day shipping if you live in one of these cities. So businesses are increasingly offering more and more services while at the same time shipping is still free. So that's and since shipping is a major selling point, so if you're a customer, when you go on a website and you notice Amazon can deliver the product in 2 days, this other company is going to take 7 days to deliver my product, you're probably going to choose to spend with buy your product on Amazon, even if it might be a few dollars more expensive, because they're going to get you your product 5 days sooner or 4 days sooner, whatever it might be. So shipping is a major selling point, and businesses are competing in this regard. So that's not good news for Amazon. Amazon has become so much more than just a retail company, just an e-commerce company. It is a formidable cloud service provider. In fact, the vast majority of Amazon's profits do come from its cloud segment. It's the more profitable segment. And in that regard, it's facing formidable competitors in that arena. Alphabet is emerging as a formidable competitor, increasing its services, increasing its capabilities, and so is Microsoft. And so they're limiting Amazon's cloud services growth and could potentially even do more than just limit its growth in the future. The next step in my framework I like to consider is valuation. And for Amazon, the stock is not cheap. Um, it's trading at a price to earnings of 114. If you look back, just a few years ago, it was a lot more expensive than that, a price to earnings of over 200 back in 2018, but that has fallen in recent years. And at 114, it's about, you could say it's about average. It's relative price to earnings ratio. Um, so not cheap. You can say average in relatively looking back at its last 5 years. But overall, in absolute terms, if you just look at a price to earnings of 114, that's expensive. Just looking at a price to earnings of 114 by itself. So different in the various ways you can consider Amazon's valuation. Uh, I would say that it's not cheap. It's hard to say. You can argue and say that it's expensive, but when you say that it's not cheap, that is more, that will face with less arguments in terms of that statement. So I can say that it's not cheap. However, I wouldn't go so far as to say that it is expensive. The next step and the final step in my framework are risks. And for Amazon, the one of the primary risks is that the stock is pricing in earnings growth that may not materialize. Amazon has experienced phenomenal growth over the last decade. As I showed earlier, the revenue has, gone from, um, and I can show you that slide earlier where we looked at where the revenue growth had gone from 61 billion in 2012 to 470 billion in 2021, and that helped operating profit margin also expand nearly fivefold. So it has delivered excellent profit and revenue growth. However, the stock is pricing in for that to continue. And while it has done that in the past, there is no guarantee that it will do that again in the future, while the stock price at a price to earnings over 100 is already pricing it in. It's already expecting that kind of growth. So that's a risk for Amazon. The second risk is that, the second of the many risks, but I'm only going to mention two. The second risk I'm going to mention is that brick and mortar retailers are gaining momentum with their own types of fulfillment services. Um, One that has become extremely popular, and Target has done an excellent job with this, is the same day services. They have buy online. You could buy online at Target, go to the parking lot, and they'll deliver it to your car, so you don't even have to come out of your car, and you can have your order within 2 to 3 hours from the time of purchase. And I've used this service several times, and it's an excellent service. And as fast as Amazon has gotten in terms of, buying and their 2 day delivery, they even have next day delivery. They're expanding same day delivery. They can't get as fast as Target can get because they have 2,000 brick and mortar stores in the US that is close to customers. They can use those stores and leverage those stores as an advantage to get customers their orders even faster and arguably more conveniently. Um, you can argue and say, I'd rather have my item delivered to my doorstep. That's more convenient. And some might prefer to just drive to Target and pick up their order, and they might say that's more convenient. But what you cannot argue is that over the last 3 or 4 years, that brick and mortar stores have developed services that is actually limiting Amazon's growth, and arguably giving it using their stores as an advantage, which wasn't the case prior to, let's say, 2019. Amazon was just growing so quickly because brick and mortar stores were becoming so unpopular. Fewer and fewer customers wanted to drive to a brick and mortar store, park their cars, go inside, walk around, look for what they wanted, find what they needed, go to a cashier, wait in line and buy it and walk all the way back to their cars. Sure, against that, Amazon was incredibly more convenient in just delivering their item after a click of a button. But now that you can, at Target at least, buy online, drive to the Target and have the item delivered in your car, to your car, without getting out, that's becoming a significant competitor to Amazon's fulfillment services. So that's something to keep an eye out for. And you can one other thing I'll add to this is that you can be assured that other brick and mortar retailers are observing the success that Target is having with their buy online, pick up in the parking lot, and they're going to implement similar services. I believe Walmart has already implemented a similar services, and that will continue expanding so long as customers continue to favor this, consumers continue to favor this. They'll see the success and they'll mimic that, and that can create an even bigger advantage, and that might divert more sales away from Amazon. All right, now that we've considered all of the items in my framework, let's look at the ratings I gave Amazon with regard to each of these. So for the customer value proposition, I gave Amazon a good score. It's the streaming service and the free, fast and free shipping for Prime members is arguably a great value, and customers have shown that with their increasing sales from 60 billion to nearly 500 billion. So good customer value. Unit economics for Amazon, I rated it as poor, and that's because it's just so expensive to deliver these items to homes, so expensive to deliver these items to the people's doorsteps, and it's hard to foresee this becoming less expensive unless technology improves. Driverless technology is one thing I'm thinking of. Um, it's just so hard to have a driver have to stop at so many doorsteps, take out the box, walk up to a consumer's door, and drop it off. So, in that regard, I gave Amazon a poor score. For the total addressable market, I noted several markets, Amazon, and they're all massive markets that it's addressing. So, I would give it an excellent score in that regard. And then I looked at the competitive position in the industry and I rated Amazon as poor, as the competitive forces poor for investors here because businesses are investing in their own fulfillment services and in that way competing with Amazon and each other in offering more and more and more to consumers. Meanwhile, it's all free for consumers, so all of these extra investments are coming at the expense of profit margins. So that's creating a poor competitive force for investors. And looking at Amazon's valuation, I looked at it in relative terms and in absolute terms, and I talked about how I wouldn't say that it's inexpensive, but I fell short of saying that it's expensive, and so I fell out saying that it's not cheap, and I would say it has a fair valuation, relatively fair, because we looked at its historical average and it's right about the average of its own historical rate. And then I looked at Amazon's risks and I said that the risks are high because the price to earnings of 100 over 100 is pricing in continued earnings growth. And even though Amazon has demonstrated excellent growth, it's now expected that it's just going to continue delivering excellent performance. And so there's a risk that it doesn't continue delivering on that. Okay, after considering all of that and determining whether or not you should buy Amazon stock, I would say Amazon stock is on the borderline between uh, holding or buying. And because of the near term pressures, consumers are now, after, economies started reopening, they're spending more money on away from home services. Meanwhile, fulfillment expenses are rising because fuel expenses are rising. Amazon is having to pay employees even more money to keep them with the company. So the near term pressures are against Amazon. So because of that, I would say Amazon is on the borderline and closer to, I would be closer to recommending investors to hold off on at least one more quarter, see where Amazon goes a little bit further, see how consumer behavior evolves before deciding on buying the stock. So that's what I think, but let me know what you think in the comments down below. And if you liked what you saw, please subscribe down below so I can keep making videos like this again. Thanks for watching.
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular Stock Advisor. Stock Advisor has beat the market by more than 250%. Go to fool.com/Parkev to get your 10 stock picks now.